You did the responsible thing. You skipped the brand new car, the one that loses about a fifth of its value before its first birthday, and you bought used. Careful, smart. So why does that number on the screen keep climbing past what the car is even worth? In early 2026, almost 1 in 3 Americans trading in a car owed more than it was worth. More than it was worth. The average gap, $7,183. That debt doesn't vanish. It follows you. From this car to the next one. By the end of this, you'll see exactly how cheap became the most expensive word in your budget. Look, this isn't one bad dealership or one bad decision. It's a system. And right now, it's quietly pulling millions of households under at the same time, 3 doors ahead. The first one looks like a bargain. The second one is where the trap clicks shut. And the third stay for this is a number we haven't seen since 1994. Let's open the first one. The word used used to mean cheap, not anymore. In 2026, the average used car runs around $26,000. And the loan to cover it, interest on used financing now sits near 12%, while a brand new car can be financed for about 7%. Read that again. You chose the cheaper car and got the more expensive loan. Here's the logic. A lender looks at an older car and sees riskier collateral, so they charge you more to borrow less. And to keep that monthly payment survivable, they stretch the loan. 5 years, 6. The average new car loan now runs almost 69 months. 7-year loans? Everywhere. Stretch it that long and something quietly breaks. The car is wearing out faster than you're paying it down. Which leaves one question hanging: what happens the day you finally try to trade it in? This is the moment it closes. You're upside down, you owe more than the car is worth. So when you trade it in, that leftover debt doesn't get erased. It gets rolled straight into your next loan. Picture it. You walk in to buy a $30,000 car. You drive off financing 37. Underwater on day 1. Buyers carrying that old debt into a new loan are now averaging $916 a month. That's not a typo. More than $900 every month partly for a car you don't even own anymore. And it stacks. Every trade piles the last loan's debt on top of the new one. The hole gets deeper each time you try to climb out. So who actually gets caught in this? That's where the numbers stop being uncomfortable and start being alarming. In January 2026, the share of subprime borrowers more than 60 days behind on a car payment hit 6.9%. The highest in 32 years. Higher than the 2008 financial crisis. Now here's the part that should stop you. Subprime borrowers, people with lower credit scores, hold only about 17% of all car loans, but they make up nearly 2/3 of the people falling behind. The people who most needed something cheap got handed the highest rates, the longest terms, and the heaviest debt. On a $30,000 loan, a deep subprime buyer pays over $20,000 in interest alone, roughly $14,000 more than a buyer with strong credit. Same car. Same road. $14,000 apart. So if cheap is the trap, where's the way out? Go back to that finance office. That pen in your hand. Here's the thing. The trap was never the used car. Plenty of used cars are still the smartest money you'll spend. The trap is the structure wrapped around it, the rate, the term, and the old debt you carry in the door. And every one of those is sitting right there on the page before you ever sign. A shorter loan. A real down payment. And the rule almost nobody wants to hear: if the only way you can afford the car is a 7-year loan at a high rate, you can't afford that car. Cheap was never about the sticker. It's about what you still owe when the car is long gone. If this changed how you'll walk into a dealership, watch this next.